Aurora Cannabis, that's the stock we are going to discuss today. Aurora Cannabis produces and distributes medical cannabis products. We know that since 17 October 2018, recreational and medical cannabis is available in Canada. However, this is not true for all the United States and Europe. Let's talk now about the possible growth factors of this big business. Just in Canada there is room for $10 billion, while globally $100 billion. There's a lot of money to be made here. Of course, they face major competition, so this is not an easy business. But apart from this, marijuana is projected to create more jobs than manufacturing by 2020. The expanded legal market is expected to hit quadruple numbers by 2022, while medical marijuana is expected to double in size. These are crazy numbers. Talking about numbers, let's see some financials here. Be ready to take down notes. They have a P/E ratio of 32.22, which is not bad considering this is a growing company. The net revenue is about 54 million, which is up from 29.6 million of September. Big growth here. 47 is from cannabis. Also, they account for 20% of the consumer market in Canada, a lot of people. Gross margin dropped substantially from 68% to 52%. This was due to lower selling prices in the recreational market and the excise tax. Cost of sales was up 3%, but in the end they had a loss of 237 million due to their large investments. The production was of 7.8 kilograms, which is a lot lower than the capacity, which is 600,000 kilograms, mainly from Aurora Sky and Aurora Sun. Aurora is the most acquisitive cannabis company after its 1.1 billion acquisition of Canimed and 3.2 billion acquisition of Med Relief. These are two big companies that cost a lot of spending. Of course, this caused concerns among investors because they used a lot of shares to buy companies. Another thing that I like is the fact that they have a cost level below $1 per gram. They have achieved this through removal of the human factor with automation. You need to know that competition will begin to get stiffer as time proceeds forward. Companies with low spending will have a head start. One disadvantage is the fact that they have less agreements compared to Canopy in Canada. This caused an expansion in Europe, which accounts for 1/4 of their revenue. Acquisition of liquor store Pedanos Shoppers Drug Mart helped this company expand in Europe further. In fact, their medical business is very big. They have 74,000 patients. There's a lot of money to be made here, and I'm sure they will expand more there, especially in countries like Germany and Italy. Everything is GMP certified, so there's no doubt about the fact that globally they are the biggest cannabis company. Of course, nothing is perfect, there are problems. Aurora now has 998 million shares outstanding, an increase of 430 million shares in mere 6 months. This is because they used a lot of shares to buy companies, and investors were very angry. I love also this quotation from Seeking Alpha. The biggest takeaway coming out from this quarter was the pressure on gross margin and Aurora's struggle to become profitable in the near term. We think the only way to close this valuation gap with Canopy and Kronos will be a partnership with an established beverage or tobacco player. The video is over now, guys. Please subscribe to this channel, follow me on Instagram, on YouTube, everywhere, and yeah, like this video. See ya.